Hey everyone, and welcome to this explainer. Today, we're diving into a genuinely fascinating and honestly pretty tricky area in corporate finance, specifically for the ACCA AA syllabus. We're talking about prospective financial information. Normally, auditing is all about looking backwards at historical data, right? We're verifying things that have already happened, there's a paper trail, there's concrete evidence. But what happens when we're asked to evaluate forward-looking financial data? Auditing the unwritten future requires a complete shift in your mindset. It is way less about ticking boxes and much more about evaluating logic and risk. And that is exactly what we are going to unpack today. Okay, let's dive into this. Here is our exact chronological journey for today. First, demystifying PFI forecasts. Second, the ethics of accepting these assignments. Third, applying heavy professional skepticism. Fourth, verifying future cash flows. And finally, the limited assurance report. All right, part one, demystifying PFI forecasts. Think of the auditor here sort of like a gritty detective investigating corporate fortune-telling. To start this investigation properly, we've got to get our definitions straight. Prospective Financial Information, or PFI, is essentially just the umbrella term for any forward-looking financial data. But under the ACCA's AAA framework, we really have to divide this into two very distinct buckets. First up, we have forecasts. Now, a forecast is management's best estimate of expected events given their current established trajectory. It's what they honestly believe is going to happen based on how the business is running right now. Second, we have projections. Projections are based on hypothetical what-if scenarios. Think about questions like, what if we just open a massive new factory overseas? Or what if our main competitor suddenly goes bankrupt tomorrow? The rules of engagement completely change depending on whether you're looking at a grounded forecast or a hypothetical projection. If you confuse the two, well, you might end up applying historical logic to a totally hypothetical situation, and that can completely derail the audit. So keeping this distinction crystal clear is our foundational step. Moving right along to Section 2, the ethics of accepting these assignments. Because as an auditor, you really have to hit pause before jumping into the unwritten future. Before we even glance at a spreadsheet or dive into the numbers, we have to stop and ask ourselves a very heavy question. Should we even accept this assignment? Stepping into a PFI engagement is incredibly risky for an audit firm. Think about the liability for a second. If management predicts massive, unprecedented growth, and you sign off saying, sure, these assumptions seem reasonable, and then the whole company collapses 6 months later, who do the investors look to blame? The liability risk is literally sky high. Because of this, it is absolutely not an automatic yes. The acceptance phase has to be treated as this highly critical gateway where we actively filter out engagements that are just too dangerous to touch. So there are specific professional and ethical hurdles we've got to clear before officially saying yes to a PFI assignment. First, we have to assess the intended use of the information. Ask yourself, is this forecast just being used internally by management to plan next quarter's budget? Or is it going into a prospectus to raise millions of dollars from the general public? A public prospectus means massive potential liability if everyday investors rely on those forward-looking numbers and end up losing their shirts. The stakes are completely different. Second, evaluate your own firm's competence. Does your audit team actually have the niche industry expertise required to judge these specific future assumptions? If it's some highly specialized AI startup and your firm only does traditional manufacturing, you might not be qualified to judge their projections. And finally, you have to take a high-level look at management's underlying assumptions to ensure they aren't clearly unrealistic right out of the gate. If a traditional brick-and-mortar retail store assumes 500% revenue growth next year without any new strategy or capital, you have to walk away. You simply cannot audit a fantasy.
Which brings us to Section 3, applying heavy professional skepticism. This is where things get a bit tense.
Now, what's really interesting about this slide is the stark contrast between the two key players in the room during a PFI engagement. On one side, we've got management. Naturally, it is their job to be optimistic and visionary. When they're tasked with creating the underlying assumptions for their forecasts, they are hardwired to assume the best-case scenarios. They believe in their product, their team, the whole shebang. But on the other side, we have the auditor. Our role is absolutely not to be a cheerleader. Our role is to bring heavy professional skepticism to the table. We have to be pragmatic, investigative, and frankly, a bit ruthless. Where management sees a guaranteed upward trend and massive future profits, we see a claim that requires solid, undeniable evidence. We have to constantly question the validity of every single optimistic assumption they put forward, ensuring it's grounded in something real, rather than just blind hope. The philosophy here is simple, but it's powerful. We don't accept the crystal ball.
we investigate the glass it's made of. You are going to hear the term heavy professional skepticism all the time in the context of corporate finance and the ACCA exams. It really is the most critical tool in your investigative arsenal. Because you literally cannot mathematically verify the future itself, since, it hasn't happened yet, you must be doubly skeptical of the building blocks management is using to construct that future. You've got to constantly ask the hard, uncomfortable questions. Where exactly did this ambitious growth rate come from? What actually happens to these margins if interest rates bump up by 2%? What is the contingency plan if your main supplier falls through? It is entirely about stress testing the foundation.
All right, let's get into the mechanics in Section 4, verifying future cash flows. So, how do you actually gather evidence for money that hasn't materialized yet? Well, it comes down to a really rigorous, methodical procedure. Step 1, isolate. You need to identify management's key assumptions, the specific variables carrying all the weight, like projected sales volume, expected inflation rates, or future labor costs. Step 2, compare. Take those isolated assumptions and bounce them against something grounded in reality. Look at historical data. Has this company ever actually achieved a 20% growth rate before, or are they pulling this completely out of thin air? Look at broader market trends too. Is the industry as a whole expanding, or is it shrinking? Step 3, recalculate. Even if the logic and the assumptions hold up to all your scrutiny, you still have to verify the mathematical accuracy of the models. Honestly, it is mind-blowing how often a beautifully presented, multi-million-dollar forecast is completely wrecked by a simple typo in a spreadsheet formula. You always have to check the math yourself.
It is vital to internalize this core concept. The auditor's job isn't to predict the future, but to verify that the path to get there is built on logical, tested assumptions. Your evidence-gathering process is never about guaranteeing that those future cash flows will definitively arrive in the corporate bank account. Literally, no one can promise that. It is exclusively about validating the foundation of those projections. If you can prove that the foundation is logical, consistent with known facts, and mathematically accurate, then you've fulfilled your professional duty, regardless of what tomorrow actually brings.
And that leads us to our final verdict. Section 5, the Limited Assurance Report. So, the crucial point is how we officially report our findings. When it comes to the official report, check out this highly specific wording. Nothing has come to our attention which causes us to believe that the assumptions do not provide a reasonable basis. Notice how strange and carefully guarded that language is? It's literally a double negative. We do not explicitly say, hey, the assumptions are correct. Instead, we say, well, nothing has come to our attention to make us think they're wrong. This is the mandatory standard wording required in a PFI examination report. It's a very precise legal and professional format designed to explicitly convey what we call limited assurance or negative assurance.
But why? Why do we use this limited assurance wording? Why can't we just give a positive, confident sign-off and say the numbers look great? It all comes down to strict legal and professional boundaries. First off, the future is just inherently uncertain. A global pandemic could happen tomorrow, or a sudden, massive supply chain disruption could change everything overnight. We simply cannot foresee every variable. Second, because of that deep uncertainty, actual results will likely vary from the forecast. Actually, scratch that. It is almost a guarantee that the final numbers will be different from the projection. Therefore, the absolute highest level of comfort we can legally and professionally provide is limited assurance. We are basically just confirming that, based on our rigorous checks, the assumptions aren't obviously flawed at the time the report was written. We simply cannot offer absolute assurance on an event that hasn't even happened yet.
Which leaves us with this final provocative thought to ponder as we wrap up today's explainer. If the future is inherently unwritten, how much assurance is too much? The world of auditing prospective financial information is this incredibly delicate, high-stakes balancing act between trusting management's vision and rigorously testing the mechanics of that vision with heavy professional skepticism. Understanding exactly where to draw that line, that's what makes the process so challenging, but also so incredibly important. Thank you so much for joining me on this deep dive, and I really hope this has brought you a much clearer understanding of how we actually go about auditing the unknown.